Welcome, everybody. As you are ushering into the hall here, we have plenty of pews in the front that are still available. So please step right on up front. We won't bite. We are here to pay tribute and celebrate the tax advantages we once knew. But we have good news. We also have people who are joining us today who are refusing to be victims, but they are going to be educated and informed and take action on what they can control. So we have a special guest speaker at today's service, and it will be Stephanie Daniel of Shoemaker. She's a partner of Jack. Everybody knows Jack. And so we'll let Jack introduce her. And we've got Adam Boatsman, and he does have a collared shirt on for the occasion, so we appreciate that. So, Jack, do you want to take it, or do you have any rants? Excuse me. Do you have any things that you would like to say, Adam?
There really has not been a lot that's been new this last week. I think Phil Berger has come out with the budget in North Carolina and just said, look, we're not going to get it done in the month of September. It's just a reminder, it is September 9th. Geez, how can you not get that done in this amount of time? But the good news is that in North Carolina, the budget included a provision to be able to deduct PPP expenses, just like the federal tax code. So, it really stinks because we're having to have people pay in money that they may get right back from the state of North Carolina, since taxes are at the individual level are done October 15th. So that's an issue. I think on the federal side, we got the same. Yeah, he is representing the Mafia Joe. That's his funeral shirt. Gary's double entendre, if that's the correct use of the word, about talking about estate taxes, which he commonly refers to as death taxes. So I think at the federal level, what we're struggling with in terms of uncertainty, besides the tax law change and the infrastructure bill, what the final number is going to be, how they pay for it. I think the thing that is affecting everybody on the call is that the Senate bill that was passed on the infrastructure bill that, the Democrats have been pretty passionate about, a big faction of them are saying, look, we got to have these two bills tied, big bill and infrastructure bill tied. Some Democrats are saying, no, we need them decoupled. Who knows who's going to win that fight? But what is causing challenges right now in our world is that in the Senate bill, the employer retention tax credit was due to expire September 30th in the bill. That is not the law, but the law still says go to December. So, if I'm reading the tea leaves right now, just based on the way everything's looking, I could see him saying, let's flip that out and let it go. I'm guessing they did that to try to get some Republican votes, if I'm just speculating, to pass the infrastructure bill. So I'm guessing that's probably, going to go till December, if I'm guessing right now. So, stay tuned on the employer retention tax credit. So yeah, I don't want to steal Stephanie's thunder on the tax law changes related to estate taxes. What I will say about other taxes, the advice that we've been giving our clients is that based on everything that we're seeing now, what we can probably count on is that on ordinary income, so that's just, income flowing through under K-1, the Senate did say we don't want to mess with small businesses. Small businesses defined as below 500 employees. That's the mark that they seem to have drawn the line in the sand, is 500 employees and below, you're considered a small business. Well, what does that mean for us? It means that the qualified business income deduction, which is, something that S corps and partnerships enjoy, probably will remain intact. So as a small business owner, probably on your ordinary income, your tax rate increase is probably going to be about 2% overall. So just kind of plan on probably going to be about 2% overall. But there are a lot of Democrats who are pushing for allowing for the state and local income tax deduction to come back into play, because right now it's phased out after a very low number. So you don't get a deduction for your state income tax anymore. They're arguing to bring that back into play. So honestly, if they say, look, tax rate went up by a couple points, but we're going to let you take all your state and local taxes as a deduction, you're back to even Stevens, baby. In terms of not feeling a tax rate increase. It's like the classic, remember, I'm a libertarian, Gary, not a liberal. It's the classic, what do Republicans do? We did great for you. We lowered your tax rates. But secretly, we eliminated a lot of stuff. So, guess what? Still a deficit. What do the Democrats say? We're going to tax the rich. Oh, we're going to give them a tax break by allowing them to deduct more stuff. It's the freaking same. Like, you close your eyes and it's effectively the same tax effect, no matter who's in charge. So that's on that one. I think on, capital gains tax, which is the other looming boogeyman that we have hanging out there. I don't think there's going to be an appetite to pass anything that goes up to ordinary rates above $1 million. So, my best guess right now is probably, split the difference, maybe 25% to 30%, might be what you're going to face at the top end of the capital gains tax rate right now. But, who knows? Stay tuned.
So I think what they're doing is, the reason that they're doing that, if they bring back the state and local tax, it's to try to stop the hemorrhaging from the high tax states such as New York and California. Just my thought. I don't know. Hey,
remember, it's supposed to be a nonpartisan discussion, Gary.
It is. Who's running those? I don't know. So anyway, Jack has done a MacGyver move today. I'm extremely impressed. It was not an intentional test to see how good he could be with MacGyvering, I don't know, chewing gum and baling wire and duct tape. But I evidently failed to allow Stephanie Daniel to be a panelist. So Jack has done a MacGyver move and given her his access. So you will see two Jack Santaniellos, but one that does not look at all like Jack Santaniello. So it's really good to have you here, Stephanie. Jack, you want to do a little rant and then introduce your partner?
Sure, absolutely. So I'll do my NPR style intro kind of overview of what's happened over the past week. And I am reading from other places. So I want to make sure I don't get into copyright infringement. So anyway, here we go. Live from Washington, this is Shoemaker News. I'm Jack Santaniello. This week, Congress begins the reconciliation process in earnest as 14 U.S. House committees are scheduled in coming days to consider the tax and spending bills in their jurisdictions that may total $3.5 trillion. The Committee on Ways and Means, the chief tax writing panel in the House, meets beginning today for what could be a 4-day markup of this bill, which will include proposals to increase individual, corporate, pass-through, capital gains, dividend, and estate taxes, as well as federal requirements for employers to provide 12 weeks of paid family and medical leave, and those without employer-sponsored retirement plans to automatically enroll their employees in IRAs or 401k type plans. But to get that bill passed, Democrats will first need to reach an agreement on the cost of legislation. Centrist Democrats, including several senators, have expressed concern about the bill's $3.5 trillion price tag, while progressives have indicated that they will fiercely oppose any attempt to cut funding in the proposal. While his entire economic agenda hanging in the balance, Biden will need to convince two fractious wings of his own party to come together and pass a comprehensive spending package. And given Democrats' extremely narrow majorities in both the House and the Senate, there's still virtually no room for error. So there is your summary from Washington. So now I would like to introduce the fabulous and fantastic and super Stephanie Daniel. So in our firm, all roads with respect to estate planning, I shouldn't say all roads, most roads, my pathway is to Stephanie. I will say that she is putting her marital bliss on the line in that her husband works for a CPA firm that does not have the acronym BGW in its domain. So thank you for that. And so we may owe her a lot at the end of the day after she gets through this, when her husband finds out that she's doing it. So anyway, Stephanie, let you run. Thank you again for joining us and walking everyone through all of this.
Oh, my pleasure. And yeah, this is off the record, right? So he's never going to find out, right?
Yeah.
My location services says I'm at the office, so he'll never know I'm cheating. So Jack asked me just to summarize the current tax reform proposals that are in front of Congress. And there are 3 of them. And as the year wanes, as we enter into the 4th quarter, we become less and less sure of what is going to get passed. And there are some effective date issues for these various tax proposals that give me indigestion as well. And so I'm going to touch on those. I'm going to start with the first tax act that was proposed, and it is the one that is an annual proposal from Bernie Sanders. Over the course of the last 10 years, sorry about that. Over the course of the last 10 years, he has introduced a tax proposal every single year. What is interesting about this year's tax proposal is really the significant attack, or I'm trying to be bipartisan, nonpartisan as well, but the significant issues related to transfer taxes. And so since I do T&E work, trust and estates work, that's always what I'm focused on. So if there are elements of the tax reform bills that I don't touch on, that's because I leave it to people who know more about those things to talk about. So my comments will be focused on kind of the transfer tax issues, or issues that are specifically related to transfer tax. You may be aware that transfer tax for years has been unified, meaning that transfers that occur during lifetime and transfers that occur during death, the same exemption is applied. That amount is currently for this year $11.7 million. So what that means is an individual can transfer up to $11.7 million of assets, either during their lifetime or upon their death, and not pay any transfer tax, not have any transfer tax liability. So one of the things that Senator Sanders' proposal includes is the deunification of those two transfer taxes. And by deunifying it, he would apply his proposal would apply a different exemption amount to transfers during lifetime versus transfers at death. So transfers of assets during a lifetime, there would be the exemption is capped at $1 million. So if you make transfers during lifetime that exceed $1 million cumulatively, then you would start paying transfer tax on those transfers. The amount at death of transfers that could be allowed is $3.5 million. And so that gives you an additional, if you transfer $1 million during your lifetime, it gives you an additional $2.5 million to transfer upon death. And the nice thing, one of the good things about his proposal is it does retain the concept of portability, which was introduced during the Obama administration. Portability means that if I have $3.5 million of exemption and I die, my husband can grab that $3.5 million to make it so that he has $7 million. So it really looks at a marital unit in and of itself when it comes to transfer taxes. In addition, to the reduction of the exemption, there's also an elimination of the flat rates for transfer taxes. So right now, the transfer tax rate is 40%. So whether you transfer $1 above the exemption amount or $100 million of the exemption amount, the amount of tax that's due is a flat 40%. Senator Sanders' proposal would change that to an aggregate or a variated rate schedule, from the lowest rate to be 40 and the highest rate to be 65%. And that would vary based on the amount of the transfers. In addition, so what I've been talking about so far is the lifetime exemption amount. There's also an annual exemption amount that an individual can make gifts every year without incurring transfer taxes on that, and a gift tax on transfers that are made annually. Currently, that rate or that amount is $15,000. So I can make $15,000 gifts to as many people as I want in a calendar year. I just can't make $16,000 gifts without paying tax on the additional $1,000. And Senator Sanders' proposal would not cap the amount of gifts that can be made, as long as those gifts are made in cash, or rather it restricts the gifts that can be made to certain entities. So if, a lot of people may fund trust using the annual exclusion gifts, and his proposal restricts those transfers to 2 transfers per donor. So if I've been funding a trust for the benefit of 4 beneficiaries with $15,000 per beneficiary per year, that's $60,000. If it's into a trust, now I can only fund it with $30,000. So I'm limited by the amount that I can transfer into the trust using the annual gift tax exemption if the transfer is made into trust. It doesn't matter how many people are beneficiaries of that trust. Additionally, this restriction also applies to interest and pass-through entities. And so a lot of times people will do prorated gifts of family limited partnerships or LLCs. So they can take advantage of discounting when they transfer assets. These transfers will also be limited to 2 transfers per donor. So 2 $15,000 transfers per donor. Speaking of valuation discounts, his proposal also includes a limitation on valuation discounts. And so what that would do, now when we apply valuation discounts, we have the assets and the entity appraised. For example, in an LLC, we have those appraised or valued. And then we apply either lack of marketability or minority ownership discounts so that we reduce the amount of the transfer. And in keeping with this Senator Sanders' proposal, he would first have you pull out any non-business assets when you're dealing with the valuation of the underlying business entity. So pull out any non-business assets. So for example, if you have rental property and you have an investment account that is not related to the rental property, you would pull out the investment account, appraise the rental property, apply the appropriate discount to the rental property portion only, and then add the investment account back on top of that. So any non-business assets in a business entity would not be subject to any type of valuation discount. Additionally, when you have a family-owned business where the family members control the entity, there is no discount for minority ownership. So that would be eliminated in its entirety. Then we switch over to the issues that he has with trusts. One of the reasons that we like to as estate planners, we like to transfer assets into trust is that there's another type of transfer tax that's called generation skipping transfer tax. And so when assets are properly classified as exempt from generation skipping transfer tax or GST tax, then as those assets are distributed we can have a dynasty trust, and they can be distributed from generation to generation to generation without incurring any additional tax. Whereas if assets are not exempt from that trust, from that type of tax, and are passed to another generation, they are taxed at every generation at currently at the 40% rate that is applicable to gift and estate taxes as well. So Senator Sanders doesn't like that, and he proposes that trust cannot be classified as GST exempt unless they are qualifying trusts. And qualifying trusts are only trusts that terminate within a 50-year time span. So what that means is that the trust itself, the language of the trust itself is such that the assets in the trust would be distributed within that 50-year period, making them subject to tax. Once those assets are distributed to the beneficiaries based on what the beneficiaries then do with those assets. But it puts the trust assets back in play for transfer tax purposes. He also doesn't like short-term grants, and so his proposal includes a limitation. Some people call it an extermination of grants, but it's certain. I don't know if it's a full extermination, but it certainly is an extermination of the effectiveness of grants. And because he wants to place a minimum of a 10-year term on grantor retained annuity trust, that's what a grat is. And he also placed restrictions on the value that the remainder interest of a grat can have for it to qualify under his plan. Also, in regards to grantor, or I guess finally, in regards to grantor trusts, he wants to make sure that any assets that someone transfers into a grantor trust are included in their taxable estate for estate tax purposes. So therefore subject to estate tax upon their death. One of the reasons we transfer assets from a planning standpoint into a grantor trust is to lock the appreciation of the future appreciation of those assets that are in the trust out of the grantor's estate. But by requiring the value of those assets to be dragged back into the grantor's estate for estate tax purposes, that effectively eliminates that type of planning. So I'll move on to the next tax reform proposal, which is from Chris Van Hollen, who is a congressman. I think he's from Maryland, but don't quote me on that.
Hey, Stephanie.
Yes.
We got a real quick question on transfer tax laws. Can I go ahead and read that one to you before we move on? Okay, cool. So this is from Robert Mayetta. We knew we could count on you, Robert. He always asks great questions, Stephanie. So here's the question. Does each state have their own transfer tax laws and exemption levels? So even if you don't owe the IRS because you're under the exemption amount, you may owe your state. Is that correct?
Okay, so maybe. Everything I've talked about is on the federal level. North Carolina does not have transfer tax. So North Carolina, and by transfer tax, I mean an estate tax. So there are certain states that still remain, assets in those states still remain subject to estate tax or inherited tax upon the individual's death. So yes. And those would have exemptions. Like, for example, I think New York is $1 million exemption. So anything above $1 million, you are paying New York state inheritance or estate tax on. North Carolina does not have that. So I don't have to focus on what the difference between state and federal. All I have to do is worry about federal. We eliminated that our estate tax back in 2009, and so we haven't had to worry about that in quite some time. But it is true that if you live in a state or have assets in a state that still has a state estate tax in effect, you do have to worry about them for both purposes. Yes.
Okay, great. Thank you very much. Also, we did get a question earlier on, and I want to acknowledge that. We'll deal with that later, though. But the question was, and so this is for Jack and Adam probably, have you heard anything about the extension of tax credits for federal paid sick leave and or EFMLA beyond September 30 expirations? So we will get to that. So Adam and Jack, get prepared for that. Okay, Stephanie, the floor
Because
is
I
back
know
to you.
nothing about that. I don't know. Okay, so moving on to the Van Halen tax proposal. This is the one that I mentioned earlier. It gives me great indigestion because I'm not sure the logistics of how this will play out. But the gist of his tax act, or the thrust of the tax proposal, is the elimination of step up in basis. So just to give a quick primer to make sure that we're all on the same page, your basis in property is basically, with some exceptions, this is the simple version, is what you paid in the property plus the cost of any improvements that you've made to the property. And then when you sell the property, the difference between the sales price and your basis in the property is what you're going to pay capital gains on. And so if I have a piece of property that I purchased 10 years ago for $100,000 and I give it to Jack, I just give it to him, my basis in the property transfers to him. So when he goes to sell the property for $1 million, his capital gains is determined by the $1 million sales price minus the $100,000 of capital gain of basis that I gave to him. So his capital gain is $900,000, which he will then pay capital gains tax on. If I die, don't be wishful thinking, Jack. If I die and leave it to Jack in my will or my trust, and it's worth I paid $100,000 for it, and it's worth $1 million when I die, his basis is the fair market value of the property when I died. So the $900,000 of gain upon my death just disappears. It just does not exist. So he gets what's called a step up in basis upon my death. His basis becomes the $1 million, and if he then sells it for $1.1 million, he pays capital gains tax on $1. And that's how it's been for years. The Van Halen proposal would eliminate that. It would eliminate step up in basis at its entirety. And so it would force the recognition of unrecognized capital gain for lifetime gifts, for gifts to non-grantor trusts, and for transfers that are made upon death. There are some exceptions. So as now, there is an unlimited marital deduction or exemption for transfers between spouses. So if I give my husband everything when I die, my estate doesn't pay any estate tax, because that's all of that is exempt because it went to my husband. Also, charities are exempt because they're exempt now. If you make a gift to charity, they don't have to recognize the unrealized gain. And transfers to grantor trust, but only if the assets in the grantor trust are included in the grantor's estate. And that makes sense because the grantor's estate is going to have to pay estate taxes on those assets. So of course it would get step up in basis at that point. Well, it's not going to be called step up, they would get a basis adjustment at that point. There is $1 million exemption for unrealized gain, or I guess $1 million of unrealized gain can be transferred during lifetime or at death without recognition of the gain. And I think that's what they're hoping covers the vast majority of people, so that, and in regards to the IRS having to track every single transfer. So there is $1 million exemption for the first $1 million of gain resulting from a transfer either during life or at death. Also, and this is a little bit similar to the issue with Bernie Sanders about the 50 trust with 50-year lifespans or more, but this is not causing the trust to be terminated. Instead, if there are trusts that would hold assets for longer than 21 years, the Van Halen proposal would tax those trusts every 21 years as though there had been a termination. So every 21 years, the trust would be deemed to have sold all of their assets so that the gains are recognized and the capital gains are paid on the unrecognized capital gains. And this would start in year 2026. So there is no grandfathering for this. It would apply regardless. So any trust that was created in 2005 or previous would start paying capital gains tax every 21 years, starting in 2026. One thing that this act does allow very generously is if there is capital gains that are triggered upon death, those can be paid over a 15-year period. However, if there are capital gains that become due based on lifetime transfers, those capital gains are due on the next tax return. So no extension of payment for lifetime transfers, only for upon death transfers. And I think in regards to that, they're really focused on taxpayers who are land rich and liquidity poor, other asset poor, so that we're not getting rid of family farms or family owned businesses that are just focused on land. So giving those types of taxpayers a little more time, to pay those capital gains as if they're triggered by death. All right, so that's Van Halen. Any questions about that? Like I said, that one gives me sincere indigestion, because as an estate planning attorney, when we do trust and estate administration, trying to track basis, I mean, I am so grateful for Step Up and Basis, because so many times there are assets that my clients own assets that have been held for generations and generations, and trying to reestablish basis can just be a nightmare. And so that Step Up and Basis is always upon death is always a nice way to just kind of reset the clock, and it's easier just to track it at that point. So that can be a huge issue, I think, going forward in regards to just tracking basis on these types of assets.
Yeah, I think, my general experience and heartburn with that particular proposal is that when you're audited, the IRS assumes that you had zero basis. As ridiculous as that is, they assume that it was zero until you can prove otherwise. So, given that a lot of these things will have been held for a long time, without really knowing, what your mom or dad, paid for it, because they're dead. they don't remember. That could be a real lollapalooza.
But I mean, that's exactly right. And there's, I have started doing this over the last couple of years, just because basis just can be an issue, especially when we're gifting assets, is starting basis files for clients. When, one thing that, when we talk about their assets and we look over what their assets are, is trying to establish what basis is over, if I can identify assets that it's difficult, trying to get that information now rather than later. And even when I have a decedent, for example, a surviving spouse, and the husband or the other spouse has died, creating a basis file for that surviving spouse upon the husband's death, so that when she passes away, there is a way to track that. So, we've been kind of trying to think about these things proactively, and now, like I said, my pulse races and my palms get sweaty when I talk about this elimination of Step Up and Basis, because I think it can be a logistical nightmare, and I don't really think that. I'm not pointing fingers at Van Halen, but I don't think that Congress has really thought about the logistics of what that's going to look like, especially with an understaffed, overworked IRS. I mean, it's just going to be a nightmare. So.
Well, that wouldn't be the first time government officials overlook the details and implications and unintended consequences.
Right.
Any
exactly.
questions for Stephanie on that one? Otherwise, and if you do, I'll be monitoring the questions and answers. So go ahead and keep rocking.
Okay,
Stephanie,
so last but not least, and I saved this one for last because it comes from the president, I feel like it probably gets more traction than these other proposals, especially, and I started with Bernie Sanders just because he puts his out every single year. There's some tweaks to it, but I think it hasn't passed in 10 years. So I think that it's the least likely to pass. But Biden's tax proposal, that's the one that the Democrats are really pushing for right now. Most recently they've passed the infrastructure, or they're trying to pass the infrastructure bill that's been approved by the Senate. And this tax reform bill, I mean, it's just super hard. It's got so many teeth in it that I think that the Democrats are probably going to need, just to pass it under reconciliation, to present a united front. And I think, to Adam's point earlier, there is a division between the progressive Democrats and the more moderate Democrats about the terms of this tax proposal. And so I think we're going to see some jockeying, because I'm not sure how many Republicans can come over or would come over in regards to support of this bill. And if they don't, the Democrats do need every single vote that they've got for it to go anywhere. But with that being said, that's the reality of the situation. So the likelihood of it getting passed, who knows? I keep telling clients when they ask me for predictions is that my crystal ball got dropped and broken. And so I haven't been good at getting that repaired. And so I just don't know where we're headed. But these are certainly the things that we need to be thinking about. So Biden's plan includes an increase of the top income tax rate on the wealthiest Americans to 39.6%. He would also eliminate the lower tax rates for capital gains and for dividends, so that households making over $1 million in income would pay 39.6, the same rate as ordinary income, 39.6 on all of their income. That's supposed to be a smoothing effect on the income generated by investments versus wages, which has been a point of disparity that the Democrats have focused on. It also, everything that I mentioned in regards to Van Hollen, in regards to the elimination of the step-up basis, is also present in President Biden's tax plan, except for the exclusion amount in Van Hollen's is just $1 million of excluded gains per individual. Biden's tax proposal does have a $2.5 million exclusion amount for married couples when it's combined with existing real estate exemptions. And of course, there's that exclusion for charity. And there are certain protections set aside for family-owned businesses and family-run farms, so that if those assets are given to their heirs, there's not an impediment in regards to having to pay capital gains taxes. They're similar to the Van Hollen Act, where there is an immediate recognition of gain on assets held in trust. Van Hollen has 21 years, President Biden's has 90 years. So there would be an automatic recognition of gain every 90 years, as if all of the assets held in trust were sold. And then in addition, and this is back to income tax, I did this out of order. For individuals paying or earning more than $400,000 in income, those individuals would also be required to pay the 3.8% Medicare tax, thereby in addition to 39.6, thereby raising the total rate to 43.4% for individuals making more than $400,000 a year. And last but not least, President Biden's proposal, and this is something that's gotten a lot of traction with my clients, because I do have a lot of clients who invest in real estate, is the elimination of the 1031 like-kind exchange provision. And so that would cause gain recognition of any properties that have been exchanged through like-kind exchanges. And the limit is $500,000 for single filers and $1 million of gain for joint filers. So that's, and President Biden's tax proposal says nothing about trust and estate, about transfer taxes, so nothing about gift or estate tax. However, it does also talk about, when they talk about that rate increasing for capital gains tax, the tax rate for capital gains, the people that I've been listening to certainly say that they don't think that he's going to get all the way to ordinary income rates for capital gains, but that he may get somewhere between 24 and 28% for capital gains might be the contribution. And according to the CBO, the Chief Budget Office, they predict that differential will be equal to the differential if a state tax exemption amount is reduced to $5 million. And so if he's not able to get capital gains tax rates to where he wants them to be, then I think a state tax, that change of the exemption amount might very well come back on the table, as part of the negotiation in trying to get this passed. So it's not in his proposal, but I don't think it's gone.
Yeah, I think our general consensus is that nobody's going to be pounding the table trying to help dead people get tax breaks. In other words, like if you're gonna have to die on the hill, better to do it on somebody that can't vote for you.
Yeah, well, I mean, but their heirs can vote.
I know, but it's so limited.
State
You're talking about not very many. So,
well, and what you're talking about is when you look at the revenue line, estate tax is never been 1% of the national revenue. And
yeah,
so
but
it's more
right.
of a talking figure. It's more of a posture for Democrats versus Republicans than it is actually making traction, doing anything with paying for anything. So.
Yeah, that's right. I mean, I appreciate that Gary's wearing the black shirt, but it is a reminder to everyone that, under Bush, they went to the level that is commonly framed up as going back to. So a Republican administration got them to a level that we were all happy with until out of nowhere, the American Tax Cuts and Jobs Act, for whatever reason they chose to do it, doubled it. I don't remember anybody screaming for, oh my God, even at $11 million index for inflation for married filing jointly, it's still not enough. We need double. It's just like, well, while we're handing stuff out, let's give away some of that too. So it's just, remember, I appreciate Gary's black tie at the same time. We are talking about rolling back to what we were all ecstatic with under the Bush administration.
It's all for effect anyway.
I know it is. It's just I'm the one that ends up having to hear about it from other people.
Uh-oh.
That's all right.
Yeah, we have a pretty wide ideological spectrum, that's okay. I think that's the way America was built,
Right.
Which I actually celebrate that. So what about this question that came in at 11:04, and I'll read it again. Have you guys heard anything about extension of tax credits for federal paid sick leave and or EFMLA beyond September 30 expiration?
I haven't heard any ballyhoo about doing something with that particular credit. However, Biden has been pretty loose with his use of executive interpretation in terms of how that credit can be applied. So I could see a scenario where he extends it via executive order because he feels that's within his domain, but I haven't heard of anything legislatively to do anything with that credit. I just think at the end of the day, no matter where we're at, there just is not bipartisan consensus to do anything from a stimulus act. I mean, if they can't even get an eviction bill passed, if they can't get an eviction bill passed, I can't see how they're going to get a bill passed to dole out more money for pandemic relief, when they're already talking about more money for infrastructure and everything else kind of post-pandemic.
And I haven't heard anything either. I tried to sneak down the hall, but Capitol Security stopped me, so I wasn't able to get very far. I did cheat and get on Google to see if maybe the IRS FAQs had any information about that. I have seen that there's been some discussion as to what the cost would be if it were extended, but I mean, that makes a lot of presumptions, but nothing really substantive that I've seen that someone has said, okay, yeah, let's move this forward, or any bill or anything else introduced into the legislation process.
So any other questions out there, feel free to hit us up in the Q&A. And by the way, in the chat, thanks to Joe. He says that Stephanie is awesome. Personal experience from Joe. So there you go. We try our best to do the screening on our guests. I guess the little tidbit that we'll have to talk to Jack about privately afterwards is the fact that Stephanie's married to somebody that's at an opposing CPA firm.
She's also a Dookie, which football season, not so much a big deal. Basketball season, it's interesting conversations in the hallway between our offices. So.
Interesting conversations. That's what you call that.
Yeah. The thing is that, Stephanie knows her stuff. And so there's no BSing. It's like, yeah, whatever, so she tells you how it is.
Jack always brings a knife to a gunfight.
Oh man, that is good.
see what I have to put up with. See, that's yeah. He was the first one in my doorway when our coach resigned, right? And so her and another person in our firm, another attorney who is a Kentucky grad, opened the door to make sure that I was emotionally okay. When so, but then her coach said he was going to resign, but at least waited a season, right? So.
Well, that's good. Sandra is also on here. She's a Dookie. So, it's interesting if Duke and Carolina grads can coexist. Surely Democrats and Republicans can coexist in this country. We would hope.
One would question if it truly is coexistence, Gary. I think if they could legally get away with it, they probably would cut each other. It's the fear of consequence that I think has that rivalry kept in check, not general congeniality.
There's still little jokes that go on. So at the beginning of the pandemic, I guess the latest one was, or one of the latest ones was, we had this little pad and it had like, how are you feeling? And it had like a smiley face and a little face. And if you were exposed, or you had to basically fill this thing out. So I filled it out and I put it on her desk and I said, sorry, you've been exposed. And so she probably knew it was BS, because I probably should have had someone else write it, maybe have our office manager write it, but yeah, it didn't go very far. She's like, yeah, whatever, blew it off.
I've been exposed since the first day I met you, Jack.
Yeah, it's really interesting. I think Jack has more than met his match. I mean, we have a high regard for Jack, but you kind of stepped up the basis, quite frankly.
Well, I am taller than Jack.
Oh boy. Now, see, that's getting low.
Well, that's Jack. Right, that's my point. Exactly.
That's getting double low. I'm sorry, Jack.
It's all right. I came into this fully prepared for whatever comes.
That's like mama jokes. There's just no response to that.
So, anybody out there with any additional questions or things to hit us up in the chat? For anybody that came on late, just a reminder, we will put this up on the BGW's CPA YouTube channel this afternoon. Go ahead, Adam.
Yeah, I think probably the only last thing I'd hit on, Stephanie, I'm what we've been telling our clients, I'd be curious to kind of get your opinion, but what we've been telling our clients is that, look, preemptively, you ought to at least use the amount of the exemption that's going to expire anyway, just preemptively, at a minimum. So have you guys been kind of doing the same thing within your all's client base?
Yeah, and that's one thing I didn't touch on is the different effective dates. So presumably the effective date for any changes to the transfer tax regime, the gift and estate tax, will be January 1 of next year. The capital gains issues, they're looking at an effective date upon announcement. And that's to make sure, the purpose of that is to make sure that there is no market chill with people trying to immediately harvest gains before the end of the year if the effective date was the beginning of next year. So, not trying to overburden a recovering market in economy coming out of the pandemic. But to your point, Adam, yeah, that is exactly right. Because if the estate tax is going to go from 11.7 either down to 5 or down to 3.5, which we know at a very minimum in 2026, it will go down back down to $5 million adjusted for inflation. So some of this is a little expediting planning that needs to happen anyway. It is going to be a use it or lose it. So if we take worst, if we hope for the best and plan for the worst, it could be 3.5 next year per person.
Right.
And so if I have a client who can afford to transition $11.7 million of wealth of their assets, whether that's into a grantor retained annuity trust or a spousal lifetime access trust, we are seeing tons of lifetime access trusts. Yes, we're encouraging them. Now, if somebody comes and says, well, I want to do $3 million. Well, why bother? I mean, there's other than to lock out future appreciation, you're not really accomplishing very much except for using all of your exemption. So I really am, especially clients who say they want to do $7 or $8 million, if they can afford to do 11.5, I'm encouraging them to do the 11.5 and just talking them. So it's education and talking them through that and why it's important and why it makes sense to do that. Of course, if I have a client who comes to me with $7 million, I'm not telling them to give everything away, to transfer everything. So, it has to be the right client. It has to be, a conversation that we have, with those clients.
Right. Okay, cool.
So
And
got
another
question.
thing
Go
I
ahead.
am worried about, and this is back to Sanders, and I was a little more worried about it earlier, back in May, was we have tons of clients with life insurance trusts, with irrevocable life insurance trusts that use those annual exclusion gifts to fund the premiums for the policies that the life insurance trust hold. And so one of the things that I was, and I have been talking to clients about this, which is a little bit less of a monetary planning, or less of a, bite for them, is overfunding life insurance trusts this year. Instead of making annual exclusion gifts, really, funding those types of trusts for the next 10 years this year, so that those premiums aren't going to be in jeopardy, if that kind of limitation to the annual exclusion amount is implemented. So like I said, it was in the Sanders proposal, so I'm not, I don't think there's a huge risk for that, but it certainly has brought up another planning opportunity for clients.
Okay.
Got a question in here for you guys. Can you remind me of when the step up in basis currently occurs when one spouse dies and their assets go into an irrevocable trust, and then the surviving spouse dies? Is it as the first spouse's death, so that therefore it is set up, it is set and not subject to these potential changes?
Okay, so here's the typical lawyer answer. It depends. So it depends on how that irrevocable trust is set up. It depends on who the beneficiaries of that are. But for typically, the situation that was described, one spouse dies and everything goes into an irrevocable trust, those trust assets would not be included in the estate of the surviving spouse. So the step up in basis would occur upon the death of the first spouse, and the successive, the death of the surviving spouse would not cause a basis adjustment. And so, that's kind of a blanket statement without knowing what the terms of the trust are and what if there could be other things that other factors that impact that answer. But typically, it's in that situation, it's going to occur. The basis step is going to occur when the assets go into trust upon the first spouse's death.
All right. And if somebody wants to dive deeper, they can contact Stephanie Daniel at Shoemaker Law. All right, cool. Any other questions out there? This has been good. You've exceeded all the hype that Jack gave you, even though, so we didn't know his biases or whatever about the whole Duke thing and all that, but, he put you on a pretty high pedestal. You've done a good job. Oh, got another question here. I'm in the process of selling my 30-year plus business, have documentation substantiating AR, AP, inventory, corporate returns, payroll, and so on for all those years. Does the buyer or the seller retain that documentation? In the event that I, as the seller, is challenged from the IRS or North Carolina State Department of Revenue, how can I address that if I don't retain this information?
So what we typically do in an M&A transaction is that those records belong to the seller as a general concept. So, but obviously there are documents that are needed moving forward for the buyer in order to do certain things, especially, especially in that very beginning period, in the transition period. But, and then you may want historical information. What typically happens is that the buyer will be entitled to, through the asset purchase agreement or the stock purchase agreement, to those records. I would say in the asset purchase agreement, entitled to copies of those records. In the stock purchase, you're buying the company. So essentially those are now your records. And then usually the seller retains copies for its own purposes, usually subject to a confidentiality requirement, non-disclosure requirement, and used only for legal or accounting purposes and no other purposes. So that's typically how that happens.
Great question. Great answer. Any other questions? This has been good. Thank you.
I want to reiterate something I said before now that Stephanie's on the line, which is, and I mentioned that my daughter turning 18, that she, suggested that we draft some documents so that in the event that we need to act on her behalf, now that she's a legal adult, that has come up a couple times, and I've offered that to the parents of her friends and to others. And but there's also other scenarios that happened a couple weeks ago. There was a spouse, and I may be getting this a little bit incorrect, Stephanie, but a friend and a client of the firm who was in a situation where, yes, she had the ability for the medical treatment for the spouse who wasn't able to vouch for himself. But then there were other issues, I think, with the insurance company. The insurance company was saying, yeah, not so fast. We need to speak to the account holder or someone who has power of attorney. There's ways to deal with that, but there's a delay in dealing with that. And, when you're in a crisis mode, you don't want to have to deal with that delay. So again, as you guys know, not trying to upsell, just making you aware that it's easy to put these things on the back burner until something happens. And it's just good to have all that stuff in order. A lot of times we'll see it doesn't happen until people become new parents, or there's a certain scenario where, a parent has a heart attack and it's like, oh gosh, we need to be able to deal with those situations. And so again, not to be doom and gloom, just basically suggesting that, you have that stuff in order. So that way it's done, filed. Hopefully you never have to use it.
Yeah, the client, that the last one that Jack was talking about, she was trying to get some information regarding her husband's short-term disability and file a short-term disability claim. And he was in a medically induced coma, and she called me to get a power of attorney. And I unfortunately had to tell her it's too late. You can't get a power of attorney. And he ended up passing away shortly thereafter. But that was a situation that broke my heart to tell her there's literally nothing we can do about that, short of going to court and asking to be appointed a guardian. But that process, especially with the delays due to the pandemic, it's just it's arduous on a best day, and it's arduous and lengthy now. And so it's just having the documents in place when you don't think you need them is really important. I also have 2 kids who just turned 18 in June, and that was their birthday present was I prepare power of attorney, both financial and healthcare for them. And I now that one of them is off at college and one of them is still here, but I do feel just better knowing that if anything happens, we have those documents in place. So.
Good and necessary stuff. This is really good. Final call. Anybody else out there that's got a question that they've been sitting on and wondering about? Now's the time to ask it. Otherwise, we will call this a day.
I'll save the dad joke for another time, because what will end up happening is every time I walk by Stephanie, she's going to roll
Oh
her
my
eyes, and I
gosh.
know exactly what that's for. So I'll wait till next week.
Yeah, you're just inviting more abuse and punishment and harassment.
I think it's grooming. I think it's character building. I don't see it the same way.
There you go. I like that positive spin. That's really good. We need more grooming in this tribe over here.
Thank you so much for having me today. I really enjoyed our time together. Thank you.
Yeah, you did
Yeah,
a
no, we
great
appreciate
job.
it, Stephanie, for sure.
Thank you, Stephanie. And thank you, Jack. I didn't know if you're going to be in DC or if you're going to be back here, but it's good to see that, you know, you're trying to keep the house in order there. And it looks pretty orderly right now.
Yeah, they haven't found me yet, and I've bribed one of the security guards, so it's all good. You know.
There you go. Starbucks cards will do wonders. It's amazing. All right, you guys. Oh, hold on here. One other thing. What contact information can be shared for Jack's firm? Jack, you want to answer that?
Yes. So go to, it's Shoemaker without a C, SHUMAKER .com. And Stephanie's bio is on there. My bio is on there, information about the firm. So happy to put you in touch with the right person. We're very fortunate to have a very diverse group of skill sets. And so, you know, whether it's tax, whether it's ERISA, whether it's, you know, stock transfers, whatever it may be. So we even do white collar criminal if you guys get yourself in trouble. So it's good. Not here in this office, but we have former assistant U.S. attorneys and judges and others in other offices that are happy to navigate through things like that. Or in the event that your dad walked, not my dad, but a client's dad walked through or tried to get through, not realizing that a firearm was still in the bag, got through security, and TSA had a little bit of an issue with that. So we had to work out those issues. And it was not purposeful, but you know, you can imagine they get that all the time. Oh, I didn't know it was in there, but truly he did not remember that it was in there. So they got through that. So hopefully it doesn't happen to you. Leave your guns at home, please.
Yeah.
Unless you're coming to spar with me.
Oh, man.
Yeah.
I like your spunk. You're going to have to come back and join us again, Stephanie.
That's right.
All right. Well, we're going to call it a day. Great questions. Thank you, everybody. Thank you, Stephanie. Thanks, Jack. And thank you, Adam. You guys
See you
have a
guys.
wonderful day.
Thanks.
See you all.
Have a good day. Go Heels.
Bye-bye.